So we are trying to look at this question on some accounting standards. It will tackle some accounting standards which we'll be mentioning step by step as we look at the adjustments. So the following is, as the question states, the following lists of balances has been extracted from the records of Kwame PLC as 31st December 2015. The end of Kwame PLC's most recent financial year is, as we can see there below. So this is the trial balance, by the way, and we want to focus mostly on the additional information. How are we going to use the additional information and show the necessary workings in our financial statements? So let us begin with the first adjustment. 1. Following an impairment review of receivables at 31st December 2015, specific invoices totaling 32,000 are to be written off. That statement is just there. What are they trying to tell us here? Well, they're looking at receivables. What have they said? They said that following an impairment review, some invoices that were totaling 32,000 are to be written off. So they've discovered that invoices worth 32 are to be written off. And if you're writing off receivables, what are these things called? These are bad debts, because bad debts come from the receivables. People have failed to pay, and that is why here they're trying to even write them off. So what's the treatment? Well, since we are being told to write them off now, the treatment will be twice. One, we have to subtract them from the receivables total, and also secondly, we would have to add them to the administrative expenses as we are computing our financial reporting statements. Let's do just that. Just before we calculate this, please take note of the trade receivables amount in the trial balance. It is 162,630. That is the trade receivables total. And as I said, the two treatments would be subtracting the written off figure from this trade receivable total, and secondly, we would have to just add it to admin. When we reach admin expenses, I will show you how to come and even show there. But for now, let's just show as working one the receivables balance, the receivables that we're going to even go and record in our statement of financial position after we adjust with this working. Yeah, so 162, as I was saying, is the balance on receivables. Take out the 32 because the written off is supposed to be subtracted. This will leave you with 130. Okay, 630 here beside. That is your receivables total that will be shown in the financial position statement under current assets. So let's move on to the next adjustment. Okay, so I want to first handle the adjustments, and then we'll come and even handle these other things like what will you now go and post in admin, what will you now go and post in the following headings of your statement of financial position as of IAS 1. That's the International Accounting Standard 1. Let's go to number 2 first. The balance on development expenditure as at 31st December 2015 comprises 120,000 spent during the year on the initial training of staff for a proposed customer call center in an overseas country with low labor costs. Following social unrest and increasing political instability in that country, Kwame PLC decided in November 2012 not to proceed any further with the project. 350,000 was spent during the year to make the company's packaging process cheaper, more efficient, and more environmentally responsible. Kwame PLC expects to incur further development costs of 107, but is not targets to introduce the new packaging process in January 2016. But is on target to introduce the new packaging process in January 2016. The new process will significantly cut costs, increase output, and will recover all development costs. Let us analyze this now. Well, this is about what? Development expenditures and the like. What standard is this? IAS 38, intangible assets. So let's see what will be categorized as development and what will we expense as research. That's what we just have to know here. Well, they've talked about the 120,000 in staff costs. Staff cost expenditure is expensed, automatically expensed. You do not consider it as development, because staff are not, it's not a guarantee that your staff are going to be kept by the company. Staff usually move out and they'll go with the skill and knowledge that they have learned. So any cost spent on training staff is directly taken to your expenses, which is the admin. That's why we'll take this 120,000. No capitalizing staff costs, in short. Next, we have this other one here. They've talked about 350,000 was spent during this same year to what? To make the packaging process cheaper. Well, for something to be categorized as development, what criteria should it check? Well, development costs should be something that they've proceeded to do it. They've got that technical feasibility to actually finish off this job, and there will be some future economic benefits from something. And if that would be seen, we can categorize something as development. And if you can see it to make things cheaper, the benefits are being seen, and then already they've told us that the packaging process will be cheaper, more efficient, environmentally responsible, and this is already relating to something that they're trying to develop. And if it's checking out at least some of those criteria as mentioned, this 350 can be development costs, and we'll categorize the development. And what do we do to development costs? We add it to intangibles. Let's understand this one. So at this point, we can even calculate our intangibles that we are going to put in the statement of financial position. How about the 107? Before we do that, just that for the calculation of intangibles, Kwame PLC expects to incur development cost of 107, expects to incur that, but is on target to introduce the new packaging process in January 2016. Well, they're just expecting to incur it. Has it been incurred yet? No. Let's understand the language they're using here. They're just expecting to incur. What we're focusing on is the expenditure that has taken place in what? In the financial year. Because when you are making adjustments or you are preparing financial statements, you're focusing on what activities have taken place in that financial year. Now here they're just expecting. So it hasn't yet occurred. The 107 will just be left the way it is. It was just an additional information for us. And you can even prove that for sure the 107 is not part and parcel of this research and development balance, as you can see there in the trial balance, because if you add on the 350 plus the 120, it's giving you what? 470, right? Yeah, that just shows you that this is what they had incurred in this period. The 107 is not even part and parcel of this total, so you can even note it's not there. That's just the explanation. You can even rewind to get the explanation once again. Now, we want to find intangibles total that we're going to now put in the financial position, and I said we have to get the 350, which we said will be our development because it checks the criteria, and of course then that will be our intangibles. So just check the trial balance if there's any intangible balance in here. Nothing. So if there's nothing, just pick on, should be Goodwill. Goodwill is part of intangibles. I'm sure you've seen the total there, 450,000. So just before we go ahead, I saw an adjustment on Goodwill. So before we even do the intangibles, we'll come and treat it after we handle the adjustment on Goodwill. Let us look at number 3 first. During the year ended 31st December 2015, Kwame PLC paid a dividend of 3 ngwe per share for the year ended 31st December 2015. A dividend was paid. Dividends paid are part of our calculations in the financial statements. The first entry is that we should subtract it from retained earnings and add it under current liabilities in the trade and other payables total. So let us just do the dividend calculation, then all those things will come and be shown at the end. So they said 3 ngwe. Let us understand the language. 3 ngwe. So, well, we want to know, first of all, how many shares does this company have? Well, if you look at the shares that the company have, we have to go to where ordinary share capital was by getting back to the question now. When you look at ordinary share capital, because this is what will give us the number of our shares which we can know the dividend payout of. Look at ordinary shares. There's 0.5 they are showing. That price is just showing you that it is the original price per share, which you can divide into the total value there, which is 1870, to give you the number of shares that are available in the company. So that's how you find the number of shares, by just dividing that original price that is attached to the word there is 15 way into that. So 0.5 is just that it was changed to kwacha, so it's 0.5, otherwise that's 15 way. So number of shares, first of all, I said find the number of shares by, this is the total value of ordinary share capital, divide by the 15 way. Since this is in kwacha, so this one was equally changed to kwacha, the 15 way, and then you find that you're getting 3, okay, that's a 3,740,000 shares that this company has. Now I want to know the payouts because they only got a pay per share. So how can you know the pay per share? By multiplying with those ingwes. Just make sure you convert the ingwes to kwacha, because here when we're finding the number of shares, we equally converted that 15 go into kwacha. That is why we are doing the same thing here as well. So when you convert that into kwacha, it can give you the value of 112,200 as the dividend payout. And as I earlier stated, retained earnings is why you record them by subtracting and added to trade and other payables, which goes to the current liability section. The goodwill arose on 1st January 2015 when Kwame plc purchased and absorbed another business as a going concern. The directors have been advised that the fair value of goodwill was 350,000 as of 31st December 2015. So, where you are told that the value of an asset is changing, goodwill is equally an asset, intangible asset to be specific. Now, where you are told that an asset is, the value of an asset is changing, what are they trying to tell you? Check for maybe, could it have been impaired? Impaired meaning the value has gone down, or could it have been revalued upwards? Maybe it has increased in value. So you go to the balance sheet, sorry, the trial balance. Check there, you have 450,000 as goodwill. How about below here? What are they telling us? 350. Has the value gone up or down? Well, it has gone down, meaning there's been an impairment. That's how we tell. And what's the impairment value? Well, usually impairment, we just usually get the carrying amount of an asset with the new value that they are proposing to be the new value in the asset. And in this case, the goodwill will be just that same 450. We have no any accumulated on goodwill. It's just the same cost that you're seeing, the 450. So you just subtract the 450 with the 350 to know how much has been impaired, which is just 100,000. The 100,000 has to be recorded where? Under your retained earnings. You can record it there. The retained earnings, you have to subtract it, impairment, and of course the other double entry usually is that it has reduced goodwill. So just make sure that impairment is recorded under retained earnings as a subtraction. Number 5, some plant and equipment was sold during the year for 440,000. The carrying value of the asset sold during the year was 290,000. Okay, and then they've told us, okay, 360 gross revaluation and 70 kwacha accumulated depreciation. Kwame plc uses the revaluation model, and revaluation reserve includes 90,000 of the revaluation surplus relating to plant and equipment sold during the year. Kwame plc, okay, those are now the following, the depreciation. So let's understand the first statement there. Some plant was sold, IAS 16, selling, disposals, treating revaluations and whatever. This is IAS 16. So now let us understand this. Well, there is the cost price, okay, 440. That's what they've told us. It was sold for 290,000. And what are we interested in? Usually when you're selling an asset, what comes to our mind? We can make a profit or a loss, right, on disposal. Now look at these other parts that you need to consider. If you're selling an asset that was previously revalued, the treatment is that if it had some revaluation, of course, surplus, like the way in our case it is, that surplus will become the profit that we'll realize from these assets. That's the treatment that is there. because it's been like a reserve of an increase in value until the day when this asset leaves you, and that's when you actually recognize it. Because when it comes to any increase in value, which is of course should be an income to us, we follow the prudence concept. When it comes to treating our incomes, we do not want to quickly recognize them. So the revaluation surplus here of 90,000 at the point of sale, like here, it will become the profit that we will realize from the sale of an asset. So whenever you are selling an asset that was previously revalued, the treatment is that that value that you had kept in the reserve becomes your profit. Nothing like you have to start calculating the difference between the carrying amount minus the proceeds. Yeah, carrying amount minus proceeds. But in this case, it's just the revaluation itself, the gain, the 90. That's what we recognize as other incomes, profit, and take the 90,000 as well out of the revaluation reserve, showing that this asset has now left the company. That's why that's the double entry we'll do just now. So looking at this calculation here on the screen, that's the revaluation reserve calculation. Well, as I said, take out the 90 as well from the revaluation reserve to show that the asset has actually left the company. So this will now leave the revaluation reserve with a balance of 260,000, which will record in the other reserves part of the balance sheet, or the financial position. Well, then the 90, I said it to be in other incomes. Let's take note of that. The 90 will be recorded under other incomes as a profit that will realize. That's what happens whenever you're selling an asset that was previously revalued. Let us finish off question 5. Well, they've told us that Kwame PLC's depreciation policies are as follows. We have land non depreciation, that's obvious. Building 5% straight line basis, okay, we have to do that. Plant and equipment 30% reducing balance method, we have to follow that as well. Furniture and fittings 35% reducing balance. Motor vehicle 40% straight line basis. So let us do the following depreciations, and I'll share the next screen of how we are going to calculate for all these assets. Well, have a look at the screen now. Building was following straight line basis, right? There you just charge on cost, no hard and fast rule on that one. There's no other alternative, or should I say there's an alternative, which is the formula cost minus scrap value over a number of years, but why are given a percentage just directly on the cost. Look at plant and equipment, reducing balance method. What are the rules? It's the cost price minus accumulated dip, which is always found you find it somewhere in the trial balance. If it's not given, then it's not given, but if it's there, always subtract first, then you charge on the difference of the two. Finally, furniture, reducing balance as well, cost minus accumulated, same process, the answer you find times the percentage given. Motor vehicle, straight line basis, directly on the cost. So just remember the rules of depreciation, and this is how you calculate for all the assets. Where do these depreciation values go? Well, they are taken to administrative expenses. That's the rule. All these depreciation charges are supposed to be taken to the admin expenses, which we're going to calculate at some point as a whole, like everything that goes into admin. So that when we prepare our financial statements, it will just be a matter of picking the total, recording it. That's it. Number 6. Kwame PLC uses the fair value model for investment properties. The market value of the company's investment properties was estimated at 1,400,000 as of 31st October 2015. As I said, whenever they tell you a new value of an asset, always check and counter check what is the previous value maybe being shown in the trial balance, so that you can know, has it been impaired or has it gained in value. Let's check. Well, look at the trial balance. We're talking about what? Investment property there. You will notice that there's a 1 million showing in the trial balance. What are they telling us the new value is? 1,400,000. Don't you think that's a gain? Yes. Any gains on investment property is 400 the standard IAS 40. The treatment is that any gain on investment property should immediately be recorded under other incomes. That's the treatment. And of course, when you're recording in the financial position, there's a component called investment property. Just go and record the new value. That's the rule that is there, because that's taken out of the increase and everything. Now, that will be clear as well. Well, so those were the adjustments. And then we're of course being asked to prepare the financial statement of the statement of financial position, the statement of profit or loss, and other comprehensive income. So before we even get there, we are left with some components that are part of these accounts we are being told to prepare. E.g., we need the admin total. We need to know what we'll put maybe as our distribution costs and the like. So let us finalize those things before we go to these financial statements. Well, what goes under administrative expenses from this question? Well, everything you can see on the screen is what we are going to put in the investment, in the administrative expenses. Of course, there was a balance in the trial balance. They told us that there was admin expense of 108. We'll start with it as our opening balance here as we're calculating. Manufacturing wages, those which were mentioned, also put them in admin. Manufacturing overheads, put them in admin. Legal and professional fees, administrative. Bad debts written off, that's one which we were supposed to write off, 32, put it in admin as we earlier stated. Staff costs, the way I stated earlier on, administrative as well. Depreciation, the depreciation was just from calculating. I said all of them, and this one is comprising of the summation of all the depreciations for the assets we are calculating. That's how we got this figure. That's what you do, and then you sum up. This becomes your administrative expense total, just like that. So that's what we meant by now need to finalize which components, according to IAS 1, which things do we need to put. We need the admin total, and so on and so forth. I earlier talked about trade and other payables. Well, that is what we'll equally put in trade and other payables. The trade payables balance itself. Bank overdraft was stated somewhere in the trial balance. It's there, 6250. This is a payable. And then dividend is also a payable. So you would record it in retained earnings, which will come and show very soon. And here in the trade payables, trade and other payables. That's why I also put the dividend twice treatment up. Yeah. We equally talked about other incomes. What goes in other incomes? We just talked about the investment property in number 6. Any gain on value of the investment property is supposed to be put directly into the other incomes statement of profit or loss. That's the 400 you're seeing there. That was the increase. The 90, where is it coming from? I said when you sell an asset that was previously revalued some time back, at the point of sale, what we recognize as a profit, in that case, it will be that revaluation gain that you got already on it that was put in the reserve account. So you put the 90 here in other incomes as what you recognize as a profit. That's the treatment that is there, especially if you had previous, unless you did not have any revaluation on this asset, and you just treat the normal way of calculating a profit or loss on disposal. Yeah, so that's what will be found in other incomes according to our question. Okay, this is yet another important working, the one you're looking at on the screen. How you're going to list the depreciations as earlier talked about for each of the assets. If you can see on the screen, I'm sure now it is now making sense. You gather the depreciations for all the assets, all of them, sum them up in that column, and that's the figure we took to admin, the one you saw. Then we're interested in the carrying amount. Why? Because the carrying amounts of each asset is what to make up property, plant, and equipment. Let's understand that. According to IAS 16, property, plant, and equipment will have to be recorded at the assets carrying amounts, or their book values if you want. So how do you get the carrying amount? It will be the cost price minus depreciation charge, the one we're just from charging, minus the accumulated which we are finding, in the trial balance. Put the depreciations together and then subtract from the costs. That's how we'll get the carrying amount for each of the assets you're seeing here on the screen. And that's how we're getting the carrying amounts for each asset, and therefore summing them up to give us what we would call property, plant, and equipment, which we record in the statement of financial position. Well, of course, not forgetting this one, intangibles. We talked about intangibles. There was that development we said would take 350,000. That one, if you remember it, yeah, we said it will be categorized as development. And why do we take development? Intangible assets. According to IAS 38, that's the treatment. Goodwill is an intangible asset as well, again according to IAS 38, and it was 350,000 as a new value, hence that is why we have recorded it as 350 there, because we are supposed to record something at its new recognized value. That's why we have to take it at 350 and not the 450 that was showing, because this value has gone down and we have to recognize that its current value. And then we sum up everything, intangibles is 700,000 that we'll recognize in the statement of financial position. Well, there's yet another working. Look at cost of sale. In the profit or loss statement, we need this heading, actually it's there. Cost of sale, what is it comprised of? Open inventory, purchases. Here we had carriage inwards is supposed to be there if it's part of the trial balance, and they talked about carriage in the trial balance. Even closing stock, it's just that this question did not have closing stock. If you go and run through it again, rewind in the video, there was no closing stock in this question, so just deal with what's there. Otherwise, closing stock is supposed to be part of cost of sale, which we subtract if it was there. Therefore, cost of sale in our case will just be that figure you're looking at on the screen. And I believe all the components should be ready now to be put in the financial statements. So let's begin with the profit or loss statement as at now, what we're going to put. So that is the profit and loss statement according to this question. We have ended on net profit or loss. That's good. It could be a profit or a loss. In our case, a loss, because that is where our information that we have in the question is showing us to end. If we had things like a gain, they would have told us maybe like gain in revaluation of an asset under property, plant and equipment, which we are supposed to show after net profit. Now here there was no other asset part of property, plant and equipment that had gained value. It was only investment property, and investment property when it gains value, you only treat it in other income. That's the rule. So have a look at the gross profit which we got. That was the difference of cost of sale and revenue. Revenue is always sales, by the way, revenue is sales. And then other incomes, we saw the total we calculated in the workings. Selling and distribution cost, it was 166 according to the trial balance. They had told us the total directly there. Admin is the one we just showed. And we usually also deal with finance costs, but it's not there. So there are times when you know the format, but we work with what the question is asking us to do. But finance cost is also another expense that is shown before finding net loss or profit. So in our case, we had the loss 152,937.5. Before you go to the financial position, make sure you handle the working called retained earnings. Retained earnings can never be done minus the net profit or loss being found. Okay, that's the rule. The treatment is actually that it's supposed to be the net profit after tax. That's the one we record in the retained earnings calculation, but we had no taxation in the question. There was no tax. I'm just giving you this hint. If you had, we take the net profit after tax to the retained earnings calculation. Now in our case, we don't have tax, therefore we just take our net profit or loss in our case and take it to the workings, because that is what our question only had. Then we can now calculate what we call retained earnings. So retained earnings, after you prepare your profit or loss statement, the advice I can give you is now calculate retained earnings as another working to your financial statement, because as we said, it requires net profit or loss, and the only way you can get net profit or loss is by preparing the profit or loss statement. That's the only way you can know it, and that's why we waited this far to prepare this working. Then we have the balance in the trial balance, 513,500. Subtract is cause the loss. If it was a profit, we would have added. Dividend is subtracted. Remember this treatment, the dividend we calculated. Impairment 100,000, we also subtract it here from our retained earnings calculation, and therefore we can get our final balance. Retained earnings, what do we take retained earnings? It's taken to the equity section of the financial position, and you will see it in my solution coming up now. So have a look at the statement of financial position. We begin with property, plant and equipment, because that is what IAS 1 states. We're supposed to prepare our financial statements according to International Accounting Standard 1. So that's the format. Intangibles, I'm sure these totals are now familiar according to the workings you are shown in this video. You just follow through, record them as they were. Intangibles is part of non-current assets. Investment property is part of non-current assets, and when you're done with all of them, you just sum them up. That's what the rules require according to IAS 1. Then current assets, trade receivables, we remember that total we calculated, that's the figure we now show as the new figure. cash and cash equivalents, what is it made up of? Okay, in our case there was only one thing, yeah, but cash and cash equivalents is just made up of bank cash itself, short-term investments. So those are the things, huh? So you look at the short-term investments, treasury bills, cash, bank, those are the main things. So in our case, we just picked one of them in our equation, and that's what was there. And that's why there was no working. And usually we only create workings if there is like more than one item, so that you can sum them up together in advance. Once you're done with all your current assets, even inventory, by the way, is supposed to be here, closing inventory specifically. But as we said, we are not closing stock. Therefore, we just end there for our current assets, sum up the current assets, then together current assets total plus non-current assets total, they will make up what we call the total assets. That's the figure seen there, which will be our balancing figure to match to the equity section. Well, the equity section is just here. Share capital is part of equity. You get from the ordinary that was in the trial balance, the 1870. There you put it. General reserve, revaluation reserve. These two, by the way, they're supposed to be recorded under the heading called other reserves. So here I just showed them separate just for the sake of you to be able to identify them, but the format requires you to put other reserves, which involves general and revaluation, the two. Then of course you would record your retained earnings just like we found them, the 148,362.5. Then further you look at your non-current liabilities, which is just the loan notes, 10% loan notes. They were recorded in your trial balance, they were there, 500,000. Trade and other payables, trade and other payables is 340,950. Well, this working was equally shown earlier part of the video, and that is what we put in our statement of financial position. Of course, there are more things according to IAS 1. We're just working with what the question had for us here. And you sum up everything, we are getting total equity and liability, which are supposed to be added actually, getting 3,219,312.5, matching with the total assets there of 3,219,312.5. We have balanced the question.